Indeed. All right, here are a couple things you need to know to kick off your Friday morning. First, big banks are kicking off earnings season this morning with JPMorgan, Morgan Stanley, Wells Fargo, and Citi leading the way. Let's start with JPMorgan here. The company beating on the top and bottom lines, really big beat on the bottom line, I should say, with CEO Jamie Dimon saying significant headwinds are immediately ahead. I think echoing what Dimon said earlier in the week on another network regarding potential recession. But the results, I would say, about what the market expected. So you had pressured investment banking. Of course, the deal activity on Wall Street has completely dried up. Has a lot, I think, bankers worried about looming layoffs ahead of bonus season early next year. Also, too, saw a little bit of weakness in the housing sector. We'll talk a little more about that later at Wells Fargo. But I would say about what the street expected. Not a great quarter, not your typical blow it out of the water JPMorgan quarter, but still a quarter that reflected a lot of the economic concerns that have rattled markets recently, guys.
Yeah. And, at the same time, the company saw that big increase in net interest income, right? 34% gain to $7.6 billion. And that's what we can expect in this kind of interest rate environment. Potentially, the fly in the ointment, though, is that even as interest rates are going higher, we are still seeing inversion of the yield curve, which doesn't necessarily mean good things for net interest margins. And all of this is maybe going to have an effect on demand. And we were showing some of the potential warning signs within the report a moment ago. $1.5 billion in provisions for credit losses, for example, which includes them building up reserves by $808 million. Home lending net revenue in the community bank, down 34%. Non-interest revenue. So net interest revenue doing great. Non-interest revenue down 8%. And then finally, some losses related to investment in securities, $959 million.
Yeah, and one of the other kind of threads that you're going to see throughout the bank earnings, especially those that do the most home lending as well as auto lending, is some of the decreases because of the number of consumers that have said, okay, we're just priced out of it right now. So where do the banks also have one of the bigger headwinds in terms of drumming up more of that demand, because it's going to come from the market here. And you're taking a look at that comparison between JPMorgan and Wells Fargo there on the screen. Of course, Wells Fargo has more of that outsized position in terms of the number of clients that they interface with on a home lending type of structure and relationship. But it's really particularly interesting to track even more of the things throughout the banks that we're going to talk about today: home lending, auto lending, and then even where there's a leaning into the card spending as well among some of the bank constituents and customers right now too, Saz.
Yeah, let's just go stand to Wells Fargo, too. I'm surprised to see the stock up about 3% here in the pre-market. And I say I'm surprised because I think some of the two most important areas, like you mentioned, Brad, with Wells Fargo, is this consumer part of the business. Sure, they're investment banking, but that's not what they're known for. And you look at the home lending business, it essentially fell off a map. You had sales down 52%. You had auto sales down 5%. I talked to Wells Fargo CFO this morning briefly on a media call, and he told us that originations across the home industry have fallen pretty significantly. And just his tone on his response to that question to me suggests this might be the new short-term run rate for Wells Fargo's key home lending business. Maybe we're sitting here 3 months from now, even higher interest rates, and you're looking at another 50% plus decline. So as an investor, you want to start thinking about, well, what are the ripple effects to Wells Fargo coming out with home results like this? It could be impacting anywhere from a company like a Home Depot to a Rocket Mortgage. This is really, I think, one of the first quarters from big banks that are showing the effects of these much higher rates.
Yeah, most definitely. There's obviously a lot to come on the housing front and that. But let's talk about the company that reported this morning that doesn't really have as much to do with that, and that is Morgan Stanley. And there, the results were not looking as good, right? And the shares are down more than 1.5%. Equity sales and trading revenue fell by 14%, missing estimates. The investment banking group saw a 55% decline in its revenue. This company's trading business outside of equities did okay. Fixed income was up by 33% here. But overall, seeing some issues here. Equity underwriting revenue down 78%. Debt underwriting revenue down 35%. So a lot of what we've seen in terms of the withdrawal of accommodation from the Federal Reserve, it has less of an effect on the consumer banks like a JPMorgan and more of an effect on a Morgan Stanley. And the company also just seems basically to not have navigated this environment, this trickier environment, very well.
And I've been tracking Citigroup here this morning, as well as we've been continuing to keep an eye on all of the banks. Citigroup shares moving higher pre-market by about 1.4% on this news. And particularly looking through some of the segments here that we had seen for Citigroup, they saw ICG, or Institutional Clients Group, that actually had $4.2 billion for this most recent quarter, $9.5 billion for this most recent quarter. That was a decrease of about 5% year over year. Services revenue, though, that put the team on its back. It was up by about 33%. But then take a look to the far right side of your screen in that banking revenue. And I want to zero in on this for a hot second. It was down by 50%. And the bank is essentially saying that the investment banking revenues of $631 million decreased 64% as a portion of that business. They cited heightened macroeconomic uncertainty and volatility due to impacted client activity. And so all of that considered really goes to spell out how the bank is still navigating through so much volatility, trying to still interface with their customers and try to give any type of sense of confidence that they can, that they're going to help them manage their money through this. But again, there's just so much of the volatility that the banks have to manage through, whether that's on a customer loan front or whether that's on a money management, wealth management front as well.
Well, and again, it's probably going to get worse before it gets better, right? And I come back to the comments that Jamie Dimon made yesterday in D.C. and then earlier in the week as well, where he's talking about potential for recession. He's talking about potential for equities to fall by another 20% and really setting the stage here for a period of time that's going to be challenging, obviously not just for JPMorgan, not even just for banks, but just for the economy and corporate America more broadly.
Absolutely.